On Friday, the jobs data numbers came out and it was bad. The numbers came very much lower than expectations. The headline number, non-farm payrolls, the expectation I think was like 110,000. We saw it come in at 73,000, which is a pretty sizable miss in and of itself. But also, prior months, they were revised lower as well. Markets also acted accordingly. We saw a pretty big sell-off across the board. So a pretty poor finish to the week last week. Now, as I'm recording this today on Monday, nice rebound. We'll see where that goes. But suffice to say, what we have to figure out is what do we make of this big miss in job numbers? What are the implications? What does this mean for the macro trajectory heading in to the end of summer as we head into the fall? What do we make of this? I think I got some good takes here, so we'll jump into it. Before we do, hit subscribe, turn that notification bell on so you won't miss any updates. Give this video a thumbs up on the way out, a like if you find this helpful. Okay, so the headline, big miss in jobs data. But what does this mean implication-wise? What can we glean from this? How does this help inform our kind of macro framework here? Well, the first question you really got to ask is, was this miss because there are firings happen, there are layoffs happening, or was this miss because hiring itself is slowing down, right? Those are two big different things. One of them, which I'm going to hopefully argue for in just a second here, is likely more associated with what I think we've seen play out since the big tariff announcement, and that is a massive supply shock. The other, if it was a bunch of firings, then that means we could be getting very close to end of cycle. So one silver lining in this is it does look like the main impetus for the miss here is because slower hirings. In other words, what I think has played out, and this is something that we have been arguing for now really since the whole tariff shock started out, is that this is some sort of supply shock, right? You get this massive kind of scenario where there is information volatility. In other words, you just don't know what's going to happen. Businesses don't know what are going to happen. You do get the tariff shock in and of itself. Everyone just decides, okay, time out, hitting pause here. Let's see how this plays out. And that is what causes supply shocks, right? Because you get a sudden stoppage across the macro landscape of macro activity, and part of that is going to be hiring. And what that ends up doing is in the immediacy, there's this demand lull. That also means that the supply of goods and services that can be purchased once this demand lull unravels, that supply also funnels in to kind of a slower flow. And the end game of this is eventually demand will open back up, but the supply itself will remain depressed. So the demand's going to hit before the supply can catch up. That creates the classic negative supply shock, which the back end of it becomes inflationary once demand kicks higher. So I think, at least at this aspect, one thing that we can take away from the jobs data that came out on Friday is, this is synonymous, this is symptomatic of what you would expect of a major supply shock. And I think the narrative that we've been building is that, as we get closer to 2026, expect inflation to start beating expectations. Not that we're going to have inflation take off the way that it did in 2021, 2022, but that we're going to start seeing inflation a little bit hotter than expected. The next aspect to this is, does this help us explain what the heck is going on with taxes? One of the big things that we track over at Applied MMT is tax receipts. And if you head on over to the site, you're an active trader or active investor, you want this data. It does update daily over there. All the data that we track is really what I would consider the most important data for understanding where the macroeconomy is going. But one of the things we track from the daily treasury statement that updates daily is tax receipts, particularly tax receipts that get paid for like FICA taxes. Because what this tells us is when tax receipts are pushing higher, that means hiring is pushing higher. And when tax receipts push lower, that means, potentially one implication is that hiring is pushing is lowering as well, right? And so tax receipts can give us kind of an understanding of what the hiring and firing cycle looks like even before we get things like the jobs data. The other thing that it tells us, and it's a very good kind of concurrent indicator, is with the credit cycle itself. And a lot of the reason that you're going to take out a loan for something like, say, loans and leases, which is up on the screen right now, is to expand production. And in order to expand production, you need to hire new people. And so you end up seeing a very strong correlation between tax receipts from the daily treasury statement and things like bank credit, right? Credit creation. And so what has been tricky, what's been interesting here is over the last couple of months, we've been seeing taxes push ever so slightly lower, right? So what I'm actually showing you here is in this tax chart is the rate of change of the accumulation of tax receipts going back to when this data begins. And so we've been seeing that rate of change decelerate while we continue to see credit accelerate. And this really shouldn't happen. You can get some divergences, but in terms of the overall trajectory, this gets a bit concerning, right? Because what this is telling us is, without broader context, without understanding why there might be this difference, is that the increase in credit that we're seeing might be going to less productive means. In other words, you should see a correlation between these two, because if you're going to expand things like loans and leases, part of that means you want to expand capacity, expand production, and that you should be pulling in more employment, and therefore more employment taxes should be showing up in the daily treasury statement. And this could be part of the explanation. The big miss in hiring could be part of the explanation of why we're seeing this divergence. Now, I've seen online as well that this could also be because a lot of the taxes that were supposed to be paid back at the beginning of the year from California have had a pause on them, and they're not going to come due until later because of issues with natural disasters. So that could be the other explanation. But I think this helps at least kind of give us a hint as to how to interpret this. And the reason that matters is because it gives us a better indication in terms of where we're at on the kind of broader Minsky cycle. What I mean by that is, I'm going to scroll up here on the screen. What I mean by that is you get up more and more in the credit cycle. As the credit cycle begins to reach its kind of apex before ultimately the inflection point hits where crap hits the fan, what you end up seeing is kind of a broader gap between credit acceleration and the actual growth that you get out of it, right? When you're in kind of a growth phase, growth and credit creation track somewhat similarly, but eventually you start to get this gap as you get closer to the top of the cycle, where you get the credit creation that is more Ponzi-like in the sense of it's going towards more speculative asset price driving sort of credit creation. And you see a divergence between credit accelerating where things like tax receipts begin to decelerate. That would be one indication that you're getting closer to the end of the cycle. So what we have to understand, and it's still kind of tricky, I don't have a definitive answer right now, but this is definitely one piece of evidence, is that, yeah, we could be getting closer to the end of that cycle because we're seeing less productive growth out of the credit creation. Well, the credit creation is clearly a driving force right now in the market, but if it's not strong economic growth, that does not bode well for the cycle as it heads to an inevitable end. So in other words, it brings forward kind of the end of that cycle in terms of time, temporally wise, condenses that cycle, gets us to the apex closer. So that is one thing to keep in mind. Again, I don't want you to read this as overly bearish here. Still, in my mind, we're probably right here in the cycle, at least maybe a year left before we absolutely peak in the credit cycle. But this is certainly the first sign that, okay, things are starting to diverge here, and we're maybe past that growth cycle, getting into more of the bubble cycle. So that is some kind of immediate macro implications in terms of how to interpret this data, how this should be informing our broader macro framework. The next thing I want to touch on is what the implication is going to be with rate cuts. Obviously, Trump has been putting a lot of pressure on Jerome Powell to cut rates, and this might finally be the jump start that the Fed needs to say, yeah, we need to cut. And I want to think about two aspects to this, because there's two sides to this coin and there's two implications. The first is, in a very real sense, this will be a cost savings, not only to if rates do end up cut. And I want to be very clear that that's not entirely a certainty at this point, but probably raises the reality that rates could end up getting cut. And one immediate implication is that will be a cost savings, right? In other words, what I mean by that is just a new loan will be cheaper. It will take the burden off of the interest payers in the private sector to the interest earners. It'll start to lower that burden, lower that cost, okay? And so that could be a kind of push forward to continue to accelerate this credit cycle. Because too, remember, we just talked about this. There was a major supply shock. Everyone's waiting on the sidelines. Now you're going to add in some rate cuts to kind of sweeten the deal, to lower your cost for new credit. Okay, that can help expand this credit cycle and set the stage for kind of that increased demand for that very narrow supply, which, as we said, could end up leading to kind of inflationary beats as we head into the end of the year. So that is one aspect of it too. Also for the households as well. That means lower mortgage costs, that sort of thing. And again, I think we've seen a lot of households also on the sidelines waiting to get through the chaos that has been the first 6 months of the Trump administration to see how how everything shakes out. And you get some rate cuts. I think all of a sudden you could see some massive cost savings on the private sector to go ahead and kind of kick things off in their own credit expansion. So kind of helping that credit bubble move along. On the flip side, though, you're going to get the fiscal add to decrease. We've had over $1 trillion in interest income last year. That train is still ongoing at this point, and the additional interest income just continues to really add a lot of fiscal support. Well, if you start getting a lot of rate cuts, the immediate impact will be the cost savings, but the longer term impact will be a diminishing fiscal add of the higher interest rates. Now, 25 basis points, 0.25% rate cut isn't going to end the train, stop it immediately. But if it's 50 basis points, then 25, and you get a whole 100, say by the end of the year, that will add up. I don't know the exact numbers, but that will, in terms of the fiscal add, but that will certainly take a couple $100 billion off the top of that add in terms of the interest income and what it has meant to the fiscal add to the entire private sector. It's going to remove that. And one of the things we've been arguing here, and I'll have a video out later this week in terms of where we're at on the fiscal side for the business cycle. But I think fiscal is maybe a little bit weaker than what most people think that it is, and that it likely could continue to get weaker into the future, maybe a little bit faster than I think most are anticipating. And so this would only be a continued headwind to the fiscal support that we're seeing. Add to that the likely inflation that we're going to see creep up into the end of the year from the supply shock, and I think all of a sudden you're going to get a bit of a mix of the sort of environment where even though you might nominally have fiscal deficits, in a real sense, we could easily end up seeing surpluses. And so, yeah, that'll end up being a big weight on the overall macro cycle and really push the cycle into a scenario where it is wholly dependent on the credit cycle. So those are the biggies in terms of what it is we're looking at, how to interpret this, and what I'm making out of the big miss in terms of the jobs data. So a little bit of a silver lining in terms of the job data, not a signal that this is end of cycle, but a continued kind of confirmation of a lot of things that we've been thinking about in terms of this idea that what we've likely seen is a big supply shock and the down path implication on rates and what this means for the broader business cycle. So that's what I have for tonight. Look, if you are an active trader, active investor, you like this type of update, you like the data that we have multiple models that takes that data and puts it in a more forecast format. We also just have the raw data. Everything I put up on here is the data that I use that is important to make the day-to-day, week-to-week, month-to-month decisions with regards to where the markets are headed. Head on over to appliedmmt.com to get access to that. Other than that, that is what I have for tonight. So until next time, good trading and follow those flows. That's the key.